Hello fellow compounders, welcome back. A fellow compounder posted the following question: how to pick dividend stocks? Why do we care? Dividend stocks are valuable components of any long-term investment portfolio. They provide a steady income stream and potential for long-term growth. But all dividend stocks are not created equal. Some stocks pay a high dividend yield and then surprise us by cutting the dividend. Some start out with a low dividend yield and increase it at a high rate. In this video, I'll show you 8 factors that I use when selecting stocks for my portfolio. I'll use Lockheed Martin as an example. We'll do a quick review against the 8 factors to determine if it's worth buying now. This video is for educational purposes only and should not be considered financial advice. I am not your financial advisor and you're responsible for your own financial decisions. Let's begin. The 8 factors to analyze dividend stocks are: number 1, dividend yield. It's the fundamental metric of dividend investors. It tells us the annual dividend payment as a percentage of the stock price. It helps investors assess the income potential of a dividend stock. It's calculated by dividing the annual dividend per share by the price of the stock. Allow me to make a side comment here. There are 2 types of dividend investors: dividend growth investors and dividend yield investors. The former focuses on dividend growth while the latter on dividend yield. The dividend growth investor seeks yields in the 1 to 4% range with a high dividend growth rate and a long runway, while dividend yield investors prefer a high yield, usually in the 4 to 8% range, and with a low to moderate dividend growth. Let's take a look at Lockheed Martin's dividend yield. If we can look at the report from Stockrover, its dividend yield is 2.6% currently. That's what we get from dividing the annual dividend of $12 by the current stock price, $458.71. Factor number 2, dividend growth rate. This is the key metric for dividend growth investors. This metric tells us the rate of change of the dividend yield. A consistent dividend growth rate indicates a healthy company. It's a symptom of improving financials and a commitment to rewarding shareholders. It is important that the dividend increases outpace the rate of inflation. This will preserve the dividend's purchasing power over time. Remember our club's motto: don't lose real money, which real means adjusted for inflation. Okay, let's take a look at how Lockheed Martin looks from a dividend growth rate perspective. We can see in this graph their dividend payout over the last 15 years. It has a very nice growth rate if we can see how nice these dividends increase over time. Their dividend growth rate over the last 10 years has been 10% annually on average, and it has had over 10 years of consecutive growth. That is spectacular. So let's continue. Factor number 3 is the payout ratio. The payout ratio is the portion of the company's earnings paid out as dividends. For example, if annual dividends per share is $1 and the annual dividend distributed is 35 cents, then the payout ratio is 35%. The payout ratio measures the sustainability of the dividend payments. Having a low payout ratio gives the company flexibility. It could increase dividends or reinvest earnings into growth initiatives. On the other hand, a high payout ratio may mean that the company is stretching to maintain dividend payments. This could be very risky. For me, a high dividend payout is above 70%. So let's take a look at how Lockheed Martin looks in this regard. Lockheed Martin's payout ratio is 52.9%, call it 53%, which is pretty healthy. It's below our 60 or 70% rate. Factor number 4, the financial health and stability ratios. Analyzing the financial health of a company is crucial when assessing dividend stocks. Look at key financial indicators such as revenue growth, profitability, and debt levels. A growing business with a strong balance sheet is more likely to sustain dividend payments during challenging market conditions. Here are the ratios that I look at for financial health. A, for me, the key indicator is return on invested capital, ROIC. This ratio is very important because it's the rate at which retained earnings are reinvested. So let's take a look at Lockheed Martin. Lockheed Martin has a return on invested capital rate of 25.3% versus the industry average of 7.1%, and the S&P is at 19.5%. So it's a very decent or very good return on invested capital. And that means that if a business pays out 53% of its earnings, which is the case of Lockheed, as dividends, the other 47% would be reinvested at the 25.3% rate, which is fairly good. In fact, I would prefer them to just reinvest all they can at that rate. So, also, I would check for consistency in the return on invested capital over the years. A consistent return on invested capital means that the business has a moat or a competitive advantage. B, debt to equity ratio. This ratio tells me how much leverage the business has. A lower number is better. A healthy business should have a debt to equity ratio below 2. So let's take a look at Lockheed. Lockheed has a debt to equity ratio of 1.6, which is pretty healthy. So check. C, earnings growth. I like to see profit growth in the double digits, greater than 10%. Let's take a look at Lockheed. Lockheed has earnings per share growth for the last 5 years at 20% per year. That's pretty good. Obviously, it had over 3 years wasn't too good, and in the last year, it grew at 26%. That's pretty good. One thing is that next year's growth doesn't look that great, but overall, we have to look at this as a cyclical business. It's better to look at the 5-year earnings growth. This is pretty good. D, revenue growth. It's important that we see top line growth, not only earnings growth. So I also like double digits above 10%, but it really depends on the industry. So let's take a look at sales growth for Lockheed. Lockheed over the last 5 years had a sales growth of 4.8%. It's below our 10% that I like to see, but given that this is a defense contractor, it really depends on government for this. But on the other hand, because it is a defense contractor, it's a very stable business. There's always a war going on somewhere, and the United States, really will never stop spending on defense. Number 5, the dividend history. Dividend history tells us how consistent and reliable a dividend stock is. The more consecutive years of dividend growth, the better. Steady dividend growth shows the company's ability to navigate various economic cycles. Look for dividend aristocrats. These are stocks that have grown and paid dividends for at least 25 consecutive years. In Lockheed's case, we already saw that graph of over 15 years of consecutive dividend growth. I mean, here they say that it has over 10 years, but we can see from the graph that it's more than 10 years. So Lockheed Martin passes that factor. Number 6, industry and competitive landscape. Consider the industry dynamics and competitive landscape in which a company operates. I'm looking for companies with durable competitive advantages, such as strong brands, intellectual property, or a unique market position. We should understand the industry's growth prospects and potential disruptors. This helps us identify dividend stocks with long-term stability and growth potential. We need to use our business judgment here. As I mentioned earlier, we can use the return on invested capital to confirm if there is a moat. If a business maintains a high ROIC, it is usually a sign of the existence of a moat. In Lockheed Martin's case, it's a government contractor. There's always going to be wars. Yes, there are competitors, but you could say it's a oligopoly. There's not that many. Let's take a look at their competitors here. Who do they list? Raytheon, Boeing, Northrop Grumman, and General Dynamics. That's it. 5. You can count them with the fingers on your hand. The government is never going to let any of these companies go out of business. They need a healthy defense supplier in order to keep the country safe. But that's a factor that we should consider when selecting our businesses or investments. And number 7, management and corporate governance. I'm looking for honest and competent management in my investments. This practice is crucial. I want experienced leaders who have a track record for creating value for shareholders. Having a shareholder-friendly management is a sign of a good business. How can we tell if management is shareholder-friendly? Well, we can do this by monitoring the communications of management to shareholders and by validating what they say over the years and what do they do. An excellent example is Warren Buffett's annual letter to Berkshire's shareholders. I would suggest reading them if you haven't already. I'm not going to take the time to go through Lockheed Martin's, but please feel free to read the shareholder letters. Factor number 8, valuation. Our final important factor is the price at which we can buy the stock. A stock may have an attractive dividend yield and growth prospects, but if you pay too much for it, guess what? It will most likely be a poor investment. There are many ways to determine value. You can compare the stock's price-earnings ratio, price-to-sales ratio, discounted cash flow, and other relevant valuation metrics. I use third-party services like Valuation, Morningstar, and Stockbroker to assist me with valuation. Now let's take a look at Lockheed Martin's valuation. According to Stockbroker, its fair value is around $461. Let's check the PEs. PE ratio is 21 versus the industry's average 37 and S&P 500 25. So I guess it's more or less okay. Its fair value at 461 and it's trading at 458 is really right around fair value. Now let's take a look at what Morningstar has to say. So here's what Morningstar says about Lockheed's fair value. It estimates fair value at $441, and right now it's trading at $458. So it's right in the zone at, I would say, around fair value. So it's not a steal right now, but it isn't overvalued either. Okay, one last check. Let's go to Valuation and see how much they estimate its value. So they think that Lockheed Martin is estimated around $412. Really, they're saying the fair value range is $319 to $505. But this was as of December of last year, so it's 6 months old. But more or less, we know from this information, we know that Lockheed Martin is trading at around fair value. So if you bought it right now, you're paying a fair price for it. So there you have it, the 8 factors I use to evaluate dividend stocks. LMT is a stock that I already own and have owned for several years. Based on my analysis today, it will stay on my watch list, but I won't be adding any more at these prices. Remember, do your homework and always be compounding. See you in the next video. Take care.